Hello and welcome to Collin Investing, where we dissect the financial events shaping your investment world. Today, we're diving deep into a series of critical developments, from the latest Federal Reserve decisions to shifts in investor sentiment and emerging market trends. We're going to cut through the noise and provide clear, actionable insights. We will start with the Federal Reserve meeting analysis. As anticipated, the Federal Reserve held interest rates steady, but what's more significant is the increasing uncertainty surrounding the economic outlook. The dot plot, a key indicator of future rate moves, projects 2 rate cuts of 25 basis points each in both 2025 and 2026. This might sound straightforward, but the details reveal a more nuanced picture. While the headline is 2 cuts, the underlying distribution tells a slightly more hawkish story. We've seen a significant shift among Fed officials now. 4 members foresee no cuts at all in 2025, a jump from just 1 previously. Another 4 anticipate only a single cut, up from 3. And the number supporting the current 2-cut projection has slipped from 10 to 9. This suggests growing caution, or even outright disagreement, within the Fed about the pace of easing. This divergence in Fed opinion leads directly to their updated economic projections. And it's here we see the real impact. The FOMC now acknowledges significantly higher uncertainty surrounding PCE inflation, core PCE inflation, and unemployment. They've also lowered the U.S. GDP growth forecast, while simultaneously nudging up their expectations for both PCE inflation and the unemployment rate. Imagine that you are in the central bank. It is not a pretty picture, and paints a scenario of slowing growth coupled with persistent price pressures, and it makes everything complex for rate decision. The projections, however, come with another significant announcement. The Fed will slow the pace of its balance sheet reduction, starting the 1st of April. Now, on the surface, reducing asset holders' quantitative tightening sounds hawkish. Fewer dollars circulating, tighter conditions, right? But, and this is crucial, the institutional read is actually dovish. Why? Because the Fed is clearly signaling that they believe tariffs. And I am saying this is not good news for the market at all. Pose a major threat to economic growth, employment, and their inflation targets. So the market's initial reaction? A collective sigh of relief, interpreted as decidedly dovish. We're seeing an increased probability of a June rate cut priced in, and the overall market response has been positive. Many analysts are now pointing to a potential rate cut window opening as early as May, or perhaps a bit later. And perhaps most strikingly, expectations for 2025 have shifted. We're now looking at a consensus of 3 rate cuts, up from the previous expectation of 2. This shows a significant shift on the market expectations. Let's turn our attention to Powell's press conference, where he tried to justify the decisions made. He repeatedly emphasized that here is absolutely no rush to adjust the current policy stance. He painted a picture of a strong U.S. economy. No, remember, he said, they're seeing a slowdown in consumer spending and rising household uncertainty. I am very doubtful about the strong part. There is some uncertainty. He also downplayed the slowing of quantitative tightening, calling it a mere technical decision. So, essentially, he's saying, stay calm, everything's under control, even while acknowledging some potentially troubling economic signals. Building on the economic data, let's delve into a critical aspect that Powell addressed: tariffs. For the first time, Powell directly acknowledged their impact. And I think this is very important. He specifically linked the recent persistently strong goods inflation data to, you guessed it, tariffs. Think of it this way. If import costs rise due to tariffs, it gets passed on to the consumers, and the inflation will likely go up. However, and I think this is the key takeaway, his overall remarks were measured, aiming for a tone of stability. He did not panic, but he did implicitly confess. And he is navigating a very narrow path right now. From the central bank, we pivot to a different but equally turbulent story: Tesla and Elon Musk. What's shocking isn't just the increasing number of attacks and the rising tide of negative sentiment towards Tesla, it's the nature of these attacks. We're talking about a website brazenly publishing the personal information of Tesla owners. Musk is calling it terrorism, and frankly, it's hard to disagree. He is publicly questioning, and you can almost hear the frustration. Why all this hatred and violence? This isn't just about market competition anymore. You see, this is something darker, something far more personal. This personal dimension, you see, links directly to something even more precarious: Musk's increasingly polarized political stance. He's become a lightning rod, and that's where things get truly complex. We are talking about his close ties to Trump, and I mean, very close. Some say it is a shift from wearing a red hat to a black hat, a very, shall we say, loaded metaphor. But consider this. what happens if, and bear with me here, what if Musk loses favor with Trump? The consequences could be severe, cascading beyond just Tesla's stock price. The consequences could be severe. He's betting big, and the stakes, I believe, are far higher than many realize. You might be wondering how all this is all impacting Musk's personal wealth. Well, despite the very public battering Tesla's stock has taken, and it has been significant, Musk remains, and I mean remain the world's richest person. But, and this is a critical but, Tesla is his primary, I repeat, primary source of liquidity. So, the stock's performance is directly tied to his financial flexibility. However, there is a twist here. X, formerly known as Twitter, is experiencing a surge in advertising revenue, and it is likely due to Musk's political alignment. Consider it as a financial buffer, and perhaps even a strategic counterbalance. So, with X acting as a bit of a financial cushion, let's shift gears to some potentially good news for Tesla, specifically in California. The California Public Utilities Commission has finally greenlit Tesla's transportation carrier license. In plain English, this allows Tesla to legally provide passenger transport services within the state. The initial plan? Use company-owned vehicles for employee trade. Think of it as a large-scale, real-world beta test, and then crucially expand to the general public. This is a step toward Robotaxi, but it is not yet. Let's turn to a valuable tool. A set of 10 market sentiment indicators compiled by Wall Street analysts. Think of it as a pulse check on the market's overall health. Right now, it's a pretty mixed picture, almost a 50-50 split. I would say 55-45. However, and I mean, this is important, with the dovish shift in rate cut expectations after the Fed meeting that tilts, it shifts the balance a bit, and it is now more like 60-40 in favor of the positives. It's like a tug of war that's leaning, ever so slightly, toward optimism. But that's not the whole story, is it? This tug of war holds the key, and it's a significant. The more of these negative or uncertain factors flick to positive, imagine the pent-up energy. We could see a rapid market rally. However, there is always the however. If negative factors continue to dominate, expect more volatility and frankly, more pain ahead. It is good to be direct sometimes to get the audience's attention. So what should you do? It is simple. Keep a close eye on the news, closely monitor, and I mean really monitor, economic data releases. This is not the time for passive investing. You have to act. Now, with all these indicators and the recent Fed decisions in mind, let's talk about what could really trigger a sustained market recovery. Goldman Sachs has laid out 3 key conditions, and frankly, I think they're spot on. First, a big, and I mean significant improvement in the U.S. economic activity outlook. We're talking about a real shift, not just marginal gains. Second, a change in stock valuations, or more precisely, how cyclical stocks, those tied to economic swings, are priced relative to defensive stocks. And third, that the investors have already moved to a low-risk position. So, basically, Goldman Sachs suggests that at least one of these things has to happen for real recovery. So, Goldman Sachs paints a conditional picture of market recovery. Shifting our focus internationally, we see a similar theme of caution. You can see this very clearly with the Bank of Japan. The BOJ just held interest rates steady at 0.5%. It is not difficult to understand their reasoning is crystal clear. A significant portion of their economy relies on exports. They're essentially in a wait-and-see mode, and I am not surprised, and waiting to gauge the fallout from tariffs and the broader global slowdown. You could almost say they are mirroring the Fed's cautious stance. And it's not just about keeping rates steady now. It is also about the future. So what will it take for the BOJ to actually raise rates? They've made it very clear. It all hinges on their assessment of the Japanese economy, and right now their own words are, and I am quoting here, some weakness. Remember the last slide? They need to see a sustainable, and I mean truly sustainable link between wage increases and price increases. It's a delicate balancing act, and they're not going to jump the gun. We just looked at how the BOJ has taken a wait-and-see approach, much like the Fed. Now, something very interesting, very telling, is happening with institutional investors. Bank of America's latest fund manager survey, and I put a lot of weight on this data, reveals a record-breaking, and I truly mean record-breaking exodus from U.S. equities. We're not just talking about a minor adjustment. We are seeing a massive rotation, with funds flowing out of the U.S. and pouring into European, UK, and even emerging market stocks. And perhaps most importantly, the survey shows a significant, and you should pay attention. Significant spike in concerns about future economic growth. They are clearly worried, and we shall see what happens. This unease, this anxiety in the market is clearly reflected in the institutional cash positions. And, check this out, we see a jump from 3.5% to 4.1% in just 1 month now. In the world of institutional investing, anything over 4%, an alarm start ringing is often considered a sell signal. This, my friends, screams caution, and this screams that big money is moving to the sidelines. While institutional cash levels tell one story, let's flip the script and look at what retail investors, the so-called little guys, are doing. And the picture, it is not pretty. Barclays data reveals a flood, and I am not exaggerating, more than $4 billion in net outflows from retail accounts in just the past 2 weeks. And consider this. During March's market drop, trading volume was 4 times the usual level. You do not need to be a veteran investor to understand what this means. This, my friends, points strongly to classic panic selling. It is capitulation. So, we've seen retail investors running for the hills, but here is where it gets really interesting, and potentially profitable sentiment. Traders' indicators, and these are closely watched, paint a stark contrast. We're seeing confidence among so-called dumb money, that's retail investors, basic, plummeting. At the same time, smart money, the institutional players, their confidence is riding well now. Historically, and I have seen this many times, this kind of divergence, this smart money buying when dumb money sells. This often, and all pay, signals a short-term market bottom. It's not a guarantee, of course, but it's a very, very compelling signal to watch. So, where does all of this leave us? We've covered central bank policy, both in the US and Japan. We have dived into GLT risks like tariffs, the elections, and shifting investor sentiment from the big institutions all the way down to individual retail traders. It's a complex picture, and it is complex. It is a tangled web of interconnected factors. Short-term volatility, given all these cross-currents, is almost, I would say, a certainty. However, and I stress, however, understanding these dynamics, understanding how these pieces fit together, that's your edge. And that is how you navigate this market, protect your capital, and seize opportunities when they arise. That's it for today's deep dive into the complexities of the market. I hope this comprehensive analysis has been valuable to you. Now, I want to hear from you. What are your predictions? Where do you see the market heading next? Let me know. In the comments section below, I read every single one. And of course, if you found this video helpful, please hit that like button and subscribe to Collin Investing for more in-depth market analysis and insights. Stay informed, stay engaged, and I'll see you in the next video.